Today, we are going to learn about the important concept of market capitalization. We will also learn about the various categories of market cap, how it is calculated, and also how it fluctuates due to external situations. So let's first understand the term. Market cap, short for market capitalization, refers to the total worth of a company's outstanding shares of stock. Simply put, it tells us how much it will cost to buy the entire company at the current share price. But how is market cap calculated? It is computed by multiplying the current market value of each share of the company by the number of outstanding shares. Here, the outstanding shares refer to the shares held by the stockholders, company officials, and public investors. So, here's the formula again. Also, the current share price is the last traded price of the company on the stock exchange. It is, of course, determined by the public based on numerous criteria, such as the company's performance, demand for the company's shares, the company's profitability, past trends, future estimates of the company's performance, and so on. For a better understanding, consider the following illustration. Britannia Industries Limited, for example, currently has approximately 24 crore shares outstanding. And as of today, the current share price is around 3,600 rupees, bringing the market valuation to around 88,600 crores. So why is market capitalization important? Market capitalization is frequently utilized as a starting point for analysis because all other financial measures must be seen through this lens. With a greater understanding of the market capitalizations of various companies, investors may make more informed selections about the types of stocks they want in their portfolios based on their investing goals. Market capitalization is significant because it allows investors to forecast the future performance of a company's stock as it reflects what the market is willing to pay for the shares. The market capitalization of a corporation also indicates its size. Now, let's understand the fluctuations that occur in market capitalization. Market capitalization fluctuates on a daily basis because it is directly related to a company's stock price. As a stock price rises, so does its market capitalization, and vice versa. Stock prices can fluctuate for a variety of reasons, including the company's reliability and reputation, past performance and forecasts, demand for the company's products, and so on. Changes in the number of outstanding shares also have an impact on market capitalization. Companies may issue new shares to raise capital or to buy back shares. Assuming a fixed share price, issuing shares increases market capitalization while purchasing them decreases it. However, a stock split or dividend usually does not change the market cap. There are certain categories of market capitalization. Companies are classified as large cap, mid cap, or small cap based on their market capitalization. This classification can assist investors in selecting the best stocks for their investment objectives and risk tolerance. Large cap. Companies with a market value of rupees 7,000 to 20,000 crores. These businesses have often been in existence for a long time and are key participants in well-established industries. These companies often reward investors with a sustained increase in share value and dividend payments over time. ITC, Reliance Industries, and HCL Tech, among many others, are examples of large cap firms. Mid cap. Companies typically have a market valuation of between rupees 500 to 7,000 crores. Mid-cap corporations are well-established businesses that engage in an industry that is predicted to grow exponentially. Mid-cap firms are in the process of growing. They are riskier than large-cap companies since they are less established, but they are appealing because of their potential for growth. Crompton Greaves Consumer Electricals is a good example of a mid-cap corporation. Small cap. Companies with a market capitalization of less than 500 crores. These small businesses may be younger or they may serve niche markets or new industries. Because of their age, the markets they serve, and their size, these companies are considered higher risk investments. Smaller organizations frequently offer more prospects for growth than larger corporations. Risks can be reduced by balancing the portfolio with a good combination of all of these. A conservative investor would prefer large cap stocks. Small caps may be a better bet if you want to take a risk. Mid caps, however, may be the way to go if you want to have a balanced portfolio with both appreciation and income. Finally, market capitalization can be a useful tool for investors who are tracking stocks and considering potential investments. The market cap is used in acquisitions to analyze whether a takeover candidate represents a good value to the acquirer. Companies with lower market capitalization values are risky, but they can pay out handsomely. Companies with larger market capitalizations are more likely to keep your money, but they may not provide huge returns. Market capitalization is fundamentally the public's opinion of a company's worth. It may be a good indicator of a company's size, but it is surely not the ideal measure for determining a company's worth. Thank you for watching VRDNation.